So we talked a little bit before we started recording about your business model, which is more of a long-term hold, a 10-year model with the goal of refinancing, and ideally refinancing 100% of your equity out and holding long-term with your investors for the remaining duration of the 10-year hold, roughly. So hopefully I gave your strategy, an accurate description. But maybe why don't you just tell us a little bit about sort of your philosophy of the more of a 10-year hold period with the refinance?
Yeah, I would say we like to say it's by investors for investors, and we're LPs in all of our deals too. That's how our deals are structured. And so we we came up with the 10-year model because I think if you look at sponsor compensation, 90% of it's tied to the exit. And so sponsors, just by nature, we're incentivized to take a property to exit, get our big check, and then roll to the next one and make new fees and new splits on the same dollars. And so we looked at that and just tried to reverse engineer, what would a deal have to look like for us to be able to keep it and for investors to be able to benefit from holding that asset and have more time in the market than a 3 year or 5 year, that just the traditional hold periods. And the reason most investors want out is they want their capital back. They don't want it
Mm-hmm.
tied up for more than 5 years. And so with the 10-year model, we just approached it and said, what do we have to buy for from a basis perspective? And what does a business plan have to look like for us to refinance 100% of capital out in that 5 year window where it's acceptable to return capital? And it's a different buying criteria. Not every deal fits that model. But when deals do, we really like the 10-year model because anyone who's trying to defer taxable events and pick up depreciation to offset capital gains, it's great for them. Anyone who is trying to build their mailbox money flow and passive income stream, one stream at a time, it's set up to allow those people to have this deal pay them and take the same dollars and go pick up another income stream. And those are the reasons we like it. I also think if you look at business plan, a lot of operators that go in with a 5 year business plan sell in three, or go in with a three, they sell in 18 months. And it's because the market works in their favor, and they can hit a crazy IRR and hit their third hurdle, and everybody does well. And for us, we said, IRR becomes insignificant or difficult to calculate when you return 100% of capital. Technically,
Right.
it's infinite. And so it's cash on cash driven waterfalls, and investors are 60% of everything lifetime of the deal. And the only difference before and after refinance is a six pref.
Mm.
And we will get comments that that's low and lower than what they see in the market. But our reason for it is we want deals that can pay a six out of the gate, and
Mm.
we don't want the pref to be what prevents or prolongs a refinance.
Mm. And so typically you're going to have to execute on this type of model. You're looking for the deeper value add plays. Is that correct? I mean, it's very difficult to execute on that type of model on newer vintage B plus, maybe lighter value add.
Yeah, it's either mom and pop owners where you have some value add upside and management upside, and you can achieve that on an 80s or a 90s product if both of those are true, or it's the deeper value add 70s, 60s C class stuff. And we renovate 100% of units typically in that model, which would be atypical for most syndications. It's you prove a percentage of the value add component and then sell it with a built-in business plan. But for us, we look at it as every 7 years or so, an asset's ripe for reposition anyways. And so if we complete our renovation year three or year four, then you have essentially the equivalent of 100% classic when you go to sell 10 years from now.